Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 10th, 2024. Hope you're all doing well. Thank you so much for coming by and spending some time to watch my weekend review podcast. Like to say hello from Santa Marta, Colombia. I am still here. I have been here over a month and I will be here for another month. I really like it so much here. I put a picture here. This is our new place we're staying. And the Airbnb, our other Airbnb, they had other guests come in that had something reserved before, so we moved here. So this is a view from my balcony at sunset, but really nice here. Really like this place. Just so chill and such a nice pace of life. And people are so friendly, and that's one of the great things about trading. You can do it from anywhere as long as you have an internet connection. So the plan for today, or the format for the podcast, is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to talk about when I entered them, why I entered them, what strategy I was using, what setup I was using, and I will explain my thinking of why I entered the trade. And then most importantly, we're going to talk about how I manage the trade going forward, either if it goes my way or if it goes against me. It's very important to always have a good plan, a good trading plan, a good trading process that you follow, and it needs to be based upon good trading fundamentals, which include looking for rejections of certain levels, having a good risk to reward ratio, having a very good defined line in the sand of where your stop is. I use two stops. I use an emergency stop and I use the end of day stop, and I'll show you as we go through here. How I place those. I also like to take profits. Partial profits of my position as it moves my way. If it gets a certain amount, if it moves a certain amount above my entry, if I'm long, then I tighten up my stop with the trailing stop procedure that I have. But you just really, whether you follow how I trade or someone else trade, just make sure that you have a plan and that you're patient with your winners and you're very impatient with your losers. Most people want to do the exact opposite. They want to give their losers room to run, and they want to be very quick to take to get out of all of their position because it feels good. But you really need to do the opposite. You need to be very patient with your winners and have a plan that lets you know how long to stay in. And if something happens, to take some profits or to take half of your position off. There's many different ways to trade, but really it comes down to position sizing correctly, being patient with your winners, being impatient with your losers. So we'll go through all my trades, uh, when I entered them, why I entered them, and most importantly, how I am going to manage them going forward. After that, we're going to do a little bit on trader psychology. Always the most important skill in trading is one of the most important skills in trading, maybe the most important skill, is to have discipline and follow that process that I was talking about, right? And sounds easy and looks easy on paper, but in real time, sometimes it's not easy. So I always like to talk about trader psychology. It's good for me to teach it, and I hope it's helpful for you as well. After that, I have gone down through my master watch list, and I have identified some trades next week, both on the daily time frames and the weekly time frames, that I am potentially interested in taking them if and when they get there. Here on the weekends, I always do my research, and I look at these charts and I say, okay, I see a level below that. If and only if it gets to that level, I'm interested in taking that trade. If it doesn't get there, fine, I'll just move on and I'll wait for something else to get where I want it to get to. If it gets there, it doesn't mean that it's going to be a profitable trade, but at least it has come to a major level that makes sense to me, or the price action of when it gets there makes sense to me, and shows me that it's more likely to go up than down. Sometimes it's going to go down, absolutely, but you just need to have an edge to show you that more than, if you have this trade 100 times, maybe 62% of the time it's going to go your way. and the rest it's going to go against. But there is your edge, and you need to have an edge. All right. I've identified them both on the daily time frames and the weekly time frames. I'll go down through them and I'll show you what I am looking for next week. And I hope that it's going to be helpful for you and that you're going to learn something. And if you do find it valuable and you are learning something, if you could hit the thumbs up button during that, I would really appreciate it. It does help out the channel and lets YouTube know that there's some valuable content here, and so they'll get it out to more people. All right, so that's the plan for today, everyone, from Santa Marta, Colombia. So let's run that U.S. legal disclaimer, get that out of the way, and then we'll get started. Thanks a lot.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. So the trades I'm going to show you, I did exit a lot of trades last week. I did have a lot of signals that told me to get out of my position, so I don't have as many trades this week, but hopefully the ones that I do have will be helpful for you. All right, let's get started. This is UNH, United Healthcare Group. I did buy this back on the 1st of February. Now, why did I buy this? Well, one of the strategies that I use and I teach is called the deep dip buy strategy. The deep dip buy strategy, the 200-day moving average, the 300-day moving average, the 250-day moving average, and the 30 RSI are all combined into the deep dip buy strategy. And the 200-day, the 250, the 300, and the 30, these are levels, deep dip buy levels that are important levels that a lot of people in the market watch, and they're a good level of support if they hold. And the black line here is why I took the trade in the first place. Here's the black line. This is the 200-day moving average. The day before, we moved up above the 200-day moving average, but it was quite far away from the 200. So I didn't like the risk to reward ratio, and I decided to give it one more day. So on the day that I bought it, you can see it went slightly below the 200 and then close back above the 200. So at that point, I need to position size based upon the volatility of the market. And I'll quickly show you how I do that. It's based about how much money you have in your trading account. Let's just use a hypothetical $100,000 trading account. 1% is a good rule of thumb. 1% of $100,000 is 1,000. If you have 200,000, it's 2,000. If you have $50,000, it's 500. So hypothetically, let's use a $100,000 account. 1% is 1,000. I'm going to take 1,000. I'm going to divide it by the value of the 2 ATR. Right now, it's 2509. So divided by 2509 would tell me to buy 39.85 shares. So I just rounded up to 40 shares. So based upon the current market volatility, which factors into the 2 ATR, and how much money I have in my account, this would be the proper amount of shares to buy the way that I trade. So we bounce at the 200-day moving average. I buy my 40 shares. I place my emergency stop exactly 2 ATRs, 2509, below my entry. This is worst case scenario. So if I have 40 shares and it moves $12 or $25.09, how much would I lose? $1,000, right? That's 1% of your capital. Not fun, but 1% is not that big of a deal. But the nice thing is, this emergency stop is only going to trigger about 5% of the time. The other 95% of the time, your loss is going to come from an end of day stop. An end of day stop is, why did I take the trade in the first place? I took the trade because it intraday rejected the 200. Therefore, if it closes under the 200, I'm just out for a small loss, right? So emergency stop, 2 ATRs below. End of day stop would be a close below the 200, which has not happened yet. Also, the orange line up here, this is my 1.5 ATR trailing stop level. If it gets to this level, then I want to tighten up my stop and I go into trailing stop mode. So you can see we have not reached this yet. If we do reach this, then I'll go into trailing stop mode, but we're not there. And then another thing I do, I always take partial profits from the previous day's close if it moves up the value of if it moves up the value of 0.45 ATRs, and the value right now is 5.64. So I would take the closing price here, 518.22, add 5.64 to it. That would be my first profit target on Monday. I take the first profit target, add it again. That would be my second. Take the second, add it again. That is my third. And how much would I take off there? Just 10% of the remaining shares that I have going into that day. So I buy here on the 1st of February at 506.56. Next day, it did move up. It moved up enough for me to take 10% off. So I take 10% of my position size off. That is tightening up your stop just by doing that, because now you have fewer shares. Next day we came back down, but we held the 200-day moving average, was under it during the day, but closed back above. That kept me in the trade. The next day moved up again, hit a profit target. Next day moved up quite large. I actually hit 2 profit targets on that. So as I'm going, I'm continually phasing out. So in case I do get a big move down, it would mitigate my loss because I'm phasing out and taking off into the gains. So this particular trade, entry to current price on the remaining shares, up 2.25%. But again, if I get up to this trailing stop level, then I go into trailing stop mode, which means that if I have a close below a previous bar's close, I'm going to get out of half of my positions. Just want to remind everybody that I do teach private one-on-one lessons in the evening time via Skype. I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level. I think the best way to learn anything is to learn one-on-one with your teacher or your instructor. I love to teach. I think I do a really good job of it. And so if you are interested in studying with me and learning the 5 different approaches that I teach, the course is 15 hours long. Each session, there's 5 sessions. Each session is 3 hours. That's where you get your 15 hours. But when you're done with this course, you're going to be a much better trader. I'm almost certain of that, because you're going to really learn a good trading process. So if you are interested, my email is in the link of this YouTube video. Okay, so UNH remaining shares up 2.25%. Disney. All right, Disney was a really good trade. I bought Disney all the way back here on the 11th of January. Why? Well, this is another deep dip buy. Here's the 200-day moving average. Here's the black line. Let me see if I can. Well, that's not going to do it either. The black line was the 200-day moving average. During that particular day, it went below the 200 and then closed back above. So I position size. I placed my emergency stop 2 ATRs below. My end of day stop was very close. I mean, talk about a risk to reward ratio. If the next day it had simply closed back below this 200, I would have got out for a very, very small loss, but fortunately it went my way. Next day moved up, hit some profit targets. Next day moved up, hit 2 profit targets. And we had a down day, but it held my 200-day moving average. And then just up some profit targets here, some profit targets here, some profit targets here, some profit targets here, and some profit targets here. And then on this particular day, I got out. Why? Because of earnings. I never hold through earnings. In this particular case, I wish I would have held through earnings, but I didn't. Holding through earnings is really a good way to make a lot of money quickly, but it's also a good way to lose a lot of money quickly. And really, first and foremost, our job as a trader is to be a good steward or a good money management of our capitals and not put us in positions where you could lose a lot of money quickly. Yes, in this case, you would have made a lot of money quickly, but our first focus, first and foremost, is to always preserve capital. So I exited before earnings for a very nice trade of 9.53%. So those, just recap on the dailies. UNH Remaining shares up 2.25%, and Disney out of the trade with a gain of 9.53%. All right, let's go over to the weekly time frames. Weekly time frames I take on Fridays because that is when the weekly bars close. Okay, I've been in this trade for a long time, and which means, what does it mean? It means that I'm in the money on the trade. I would not be in a trade a long time if it were a losing trade. So here we go. Can't believe this. I've been in this trade since the 24th of March, almost a year. Why have I been in this trade for almost a year? Because my process told me to stay in the trade. So I bought this all the way back here, 324.23. During that week, we went below the 250-week moving average. We also rejected the negative third ATR channel. Again, these are things I teach in my private 101 course. I got long here, 30.71. I position size. I placed my emergency stop 2 ATRs below. My end of week stop is simply a close below the 250 week. Next week it moved up, so I took profits. We had a sideways week or a nothing week. Next week moved up, took more profits, also got to trailing stop mode. Now if I get a close below a previous bar's close, I'm going to get out of half. Went down, but it never closed below previous bar's low until here on June 23rd, 2023, where we had our first close below a previous bar's low. I got out of half of the remaining shares for a gain of 6.4%. Then we had a month rally where I took profits into the strength. Then we had, several months of down movement. And then on this particular month or week here on the 27th of October, if this had closed below the 250 week, I would have gotten out, but it did not. It closed back above. Again, that's my process telling me what to do. That's it. If it would have closed below, I would have gotten out. And then look at this skyrocket move. Huge up, took profits. Huge up, took profits. Up again, took profits. Up again, took profits. Up again, took profits. So right now we are at a 73.37 RSI. Very easy. I know exactly what I'm going to do on this trade. And if we reject the 70 RSI, I will sell half of my shares, but because we're above the 65 RSI level, the 5 EMA comes into play. This is this thin blue line here. In the future, whenever it closes below this 5 EMA, and it eventually will, I will simply be out of the trade. So once I get to a 65 RSI level and then I close below the 5 EMA, I'm simply out of the trade. And again, this is one of the rules that I've been using for 28 years, and also what I teach in my one-on-one course. So it's really good, a tight trailing stop level. This particular trade, the remaining shares up 21.47%. So really good trade on that, starting off with a very good risk to reward ratio all the way back here a year ago. All right, Johnson & Johnson, J&J. All right, here we go. I bought J&J back here on the 15th of December. Why? Well, this was an intra-week rejection of the black line, or the 200-week moving average. In addition to that, I also have a V1 formation, bar 1. Bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. This is a V1. Now, this is not the entry signal, the main entry signal. The main entry signal was a rejection of the 200-week moving average, but you'll always improve the chances of having a good trade if you have a confluence of signals, not one, but 2 or 3 or 4 different signals and or entry triggers. And so if you have 2 trades that you're looking at, you're having to decide between 2 trades, maybe Apple and, I don't know, Exxon. And Apple has 1 entry signal, but Exxon has 2 or 3 entry signals. Of course, that's the one that I would take because the more entry signals you have, the more likely that's going to be a positive trade. It doesn't have to be a positive trade, certainly, but it improves the chances. So looking for confluences and combination of indicators lining up not only on one time frame, but on 2 time frames really improves your chances. And again, these are the things that I teach in my one-on-one course. So, intra-week rejection of the 200-day moving average, a V1 entry signal. I got long at 154.27. I position size. I placed my emergency stop 2 ATRs below my end of day stop, or excuse me, end of week stop. In this case, is simply a close below the 200. Next week went down, but it did recover and close back above the 200. Next week we moved up, took a little profits. Next week we moved up again, took some more profits. Next week we moved up and got to my trailing stop level, which means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. And that happened here on the 26th of January. Closed below the previous bar's low after reaching trailing stop level, got out for a gain of half of 3.33%. So I still have half. Next week it went down. This week was up slightly, very, very slightly. But the main thing is that it is holding the 200-week moving average. Next week, if it closes below the 200, boom, I'm just out. But if it does close below the 200, I'll be very grateful that I took profits here and here, and that I got out of half here. So in the course and the lessons that I teach, every single rule that I use, the trailing stop, the partial profits, the process that I use has been so well thought out over the last 20 years that that's why all these rules in this process is so valuable. And I can show you trade after trade after trade where using these approaches, the partial profits and the trailing stops, not only will help make you more money, help you save more money, but most importantly, keep you in a good mental headspace. It's so important to have a process that you can follow that not only makes you more money, saves you more money, but keeps you grounded and centered and in a good mental spot in your trading. I don't think people talk about it enough. They just talk about how much you make or how much you lose, but there's some ethereal things here too about what your state of mind is. And that's why I incorporate all these, not just for the money, but for the mental stability. So the remaining shares on J&J, not up a lot, but up 1.59%. All right. Unity Software. This is a trade that I took yesterday on Friday, and this is one of my favorite approaches. Again, this is something that I teach in my private one-on-one courses, but this is what we've gone over so far today have mainly been the deep dip buy approach. Well, this is a different approach. This is one of the 5 that I use and teach, but this is a different approach. This is called a return to value V1 or V2. In this case, it's a V2. So what does return to value mean? Well, this is the value zone. The green line here, the green line here. Anywhere in between here is considered the value zone. I don't like to buy above value. I like to buy in value and sell above value, or buy below value and sell into value. A lot of people chase stocks way above value. It's like paying more than retail, right? I want to pay a decent price or a bargain price, not pay the highest price. If you're buying food or clothes or anything else like that, you're always looking for a deal. Well, on stocks are one of the only things that people want to buy full price. I'm not sure why. So using this value zone here is a very important area. It's very important because it shows you, and it just, black and white, are you in value? So here we were above the value zone. So I don't want to buy up there. That's a no-go zone for me. We have now, the price has returned to value. It's inside of the green bars. It's returned to value very nicely. It has moved sideways, which is another one of the requirements. So the first requirement is you have to be above value. Second requirement, you have to come into value. Third requirement is you have to have sideways motion, which you can see, sideways motion, or in other words, consolidation or price discovery. And once this formations happens, then if you get a V1 or a V2, that is your trigger. And if you'd like to learn more about V1s, V2s, you can go to my YouTube channel, free video in the lessons playlist called V1s, V2s. And this is a perfect setup. Return. The price was above value. We've returned to value. We had sideways motion, and then we have a V2. Bar 1, bar 2. Bar 2 goes below bar 1's low, washes out bar 1's low, and then bar 3 closes above bar 1's close. So this is a valid return to value sideways motion V2. So on Friday when I bought that, I position sized correctly. Okay. Placed my emergency stop how far below my entry? $7.70, or in other words, 2 ATRs below. Now, on a return to value V1 or V2, we're not using a 200 or a 300 or a 30 RSI for our demarcation line for our stop. So end of day stop on a return to value V1 or V2 is a close below halfway of the washout bar. This is the washout bar. This is bar 2. It washed out bar 1. So in the future now, if I get a close below halfway, close, not intraday, but close below halfway of the washout bar here, I am simply going to get out of the trade. My 1.5 ATR trailing stop level is up here. If it moves up to there, then I'll go into trailing stop mode. And again, next week, if it moves up, I will take partial profits. Right now, the value of the 0.45 ATR here is 173. So I'll take 33.82. I'll add 173 to it, whatever that is. That will be my first profit target next week. And if it does get there, I will get out of 10% of the position. So this trade, I just barely got it in on Friday. I got in a little bit early. It's already up 1.27%. And then also it looks like here in my charts, we have earnings on the 26th. Regardless of where I am on this trade, I will exit this trade before earnings, like I did Disney. So just a quick recap on the weeklies. XLF, the remaining shares are up 21.47%. Johnson & Johnson, the remaining shares up 1.59%. And Unity Software already up 1.27%. All right, let's get on to a little trading psychology. This is from my friend Stephen Goldstein. Stephen is a retired trader and actually now world famous trading coach. You can follow him over at Alpha Mind 101 over on Twitter. And he also has a great podcast, the Alpha Mind Trading Podcast, which he interviews all sorts of different traders, from retail traders up to large institutional funds. I was fortunate enough to be interviewed twice on his podcast. So check it out, Alpha Mind 101, and you can find all of his podcasts there as well. But let's see what Steve has to say. Cutting losses, easy in theory, far more difficult in practice. The monetary hit is rarely the issue. Rather, it is the emotional hit to your ego and the shame and the recollections of inadequacy this triggers. That's why the mind, not the market, is where the battle is. You know, and it's really true. Some people do not have issues or problems at all of getting out of losing trades. Some people have a lot of issues with it, and I think Stephen sums this up very well here. Cutting losses, easy in theory. Yeah, it is easy in theory. Far more difficult to practice. The monetary hit is rarely the issue. It's true. The money that you're losing is rarely the issue. The issue, rather, is the emotional hit to your ego. I was wrong. I don't want to be wrong. And the shame and the recollections of inadequacy this triggers. So something in your life, something in your past, you've had some shame and or feelings of inadequacy, and that taking the loss triggers all that and brings that back, and you don't want to be wrong again. It's pretty deep, but it's really true. But nonetheless, to be a profitable trader, you have to cut losses quickly. You have to cut them quickly without it, triggering that shame spiral. So, maybe take some self-reflection and look at this. Listen, as traders, we're all going to take losses. You can't take them personally. We can't be right 100% of the time. But if we're patient and we wait for a good signal with a defined risk to reward ratio at a legitimate level, if you're wrong, the losses can be small and the potential winners can be large. And that is what the proper way to trade is. So really good. This is deep stuff. Cutting losses, easy in theory, far more difficult in practice. The monetary hit is rarely the issue. Rather, it's the emotional hit to your ego and the shame and the recollections of inadequacy that triggers. Wow, that is a great post. That really is a great post because it sums it up. So if you're having issues with taking losses, you might want to reflect on this post and realize that it's probably not the money. It's probably hit to your ego and recollections of inadequacy. But let's get past that and just know the best way to be a profitable trader in the long run is to get out of your losses. It's just part of it. So hopefully by hearing this, reading this, hopefully it will kind of help you transcend that. It's not a reflection of you, your inadequacy or anything like that. It's just a cost of doing business. So I would suggest if you have issues with this, read this through a couple times, reflect on it, and hopefully that will help. So thank you, Stephen Goldstein. Really appreciate that. Really great post. Please follow Steve at AlphaMind101 and listen to his podcast, the AlphaMind 101 podcast. All right, let's get on to potential trades for next week. Now, I don't have a lot of these. But the ones that I do have are good here, and I do want to remind you that I do teach private one-on-one lessons in the evening time via Skype. I teach you all 5 of the different trading approaches that I use. We go through chart after chart after chart. We do simulation trades, but I teach you step by step how to trade all of these, all of the rules, and kind of nice for you to be able to do for yourself. So if that's of interest, just email me. My email is in the link of the description. And by the way, the course does cost $1,750, but I promise you it is worth every penny for the one-on-one coaching that you get and all the process-driven things that I teach you. So I think it's worth every penny, and you should definitely consider it. Okay, Apple on the daily. Haven't talked about crossovers in a while. Because I haven't seen many crossovers that I like. And again, this is one of the approaches that I use. This is a good setup for a 520 crossover. This is the 5 EMA, this thin blue line. The darker blue line is the 20 EMA. Apple, if you backtest Apple of getting long Apple, when the 5 crosses over the 20, this is a very good back-tested approach. Doesn't mean every time the 5 closes over the 20 that you're going to make money, but over time, back-testing the 520 does provide an edge and is a profitable trade to take. Now, I was just teaching on Thursday with a student of mine, Andy, and we were discussing 520 crossovers. And I don't just take any 520 crossover, but the crossovers that I like the best are the ones where you have sideways motion or consolidation. Well, look at Apple. It's definitely consolidating here, wouldn't you say? It's moving sideways. The 5 right now is 188.43. The 20 is 188.69. So if we move up on Monday or Tuesday, any kind of decent move up on Apple, the 5 will most likely cross over the 20, and that is a legitimate trade. And for me, it's a very legitimate trade because the sideways motion preceding the 520 crossover. So the big picture is the consolidation. The entry trigger would be the 5 crossing over the 20. The stop on that trade, by the way, is if the 5 then in the future closes back under. So I like this trade. Doesn't mean I'm going to 100% sure take it. I have 5 different symbols here and theoretically, all 5 of these could trigger on the same day. Does that mean I would take all 5 trades? No, I would only take one trade. I would take the best one out of the 5. And how do I determine that? Well, which one has the most confluences of signals? Which one has the best risk to reward ratio? Which market had the highest relative strength compared to the rest of the market that day? Which one looked better on a higher time frame, right? That's kind of the secret sauce, is being able to narrow down legitimate trades and find the best one. And again, these are the things that I teach in my one-on-one course. So Apple, very interested in Apple next week with a 5 crossing over the 20 as a potential entry. Boeing. Okay. Boeing right now, of course, we had that big hit to Boeing. And what I am looking at right now is the 300-day moving average. This is a deep dip buy, okay? What I just showed you on Apple was a crossover, but this is a deep dip buy. 300-day moving average, the orange line here. This is an important level. This is a key level, and you can see here on the 30th of January we were below it. Then we closed back above it, and then we closed back below it, and then we closed back above it, and then we close back below it. But each time we close back above the 300, it's a higher low. You can see here we have a low, we close back above. And then here we close below, we close back above. But you see how this high is lower than this high. What I am looking for next week is a potential close back above the 300. I mean, on Monday, if we close back above the 300, this high would be higher than this high. This high is higher than this high. So higher low closes in the value zone back above major moving averages are always better than lower low closes. This was a lower low close, closed above, failed. This is higher low, closed below, closed above, failed. But what I'm looking for next week is potentially a close back above the 300-day moving average, again giving me an additional higher low close back above. MACD is green. Alternatively, if we move down, a 30 RSI deep dip buy would also be good too. And I can just tell here from experience, you look at the red MACD bars, if we come back down and test this low, we will definitely have a double bottom with a bullish MACD divergence. We will also have a ATR divergence. I'm sure we'll have an RSI divergence. We'll have all sorts of divergences. So if we go lower, under 30, over 30, absolutely, I will buy that as well. And by the way, the divergences that I just talked about, this is another approach that I teach in my lessons. So two moves here. If we move next week, if we move back above the 300-day moving average, I will consider that. My 300-day moving average would be my end-of-day stop. Or conversely, if we move down to the 30 RSI and reject that, we'll have double bottom with multiple divergences as well, and the trigger would be an under 30, over 30. Carnival. Okay, so I've been talking about Carnival, I guess now for a couple weeks. And I said, if we get down to the 200-day moving average, the black line, that would be a good entry point to get long Carnival. Well, look at that. On Friday, we literally almost to the penny got to that 200-day moving average. Why? Because as we approached the 200-day moving average, buyers said, okay, we're getting close to the 200-day moving average, and buyers stepped in. Short started to cover, so there was two groups of buyers buying at the same level. Now, this was a legitimate entry trade on Friday. I could have taken this. This is a bounce at the 200-day moving average. I decided not to. I took, what did I take? What did I take instead? I should know. Yeah. Oh, Unity software on the weekly. Yeah. So I decided to pass on CCL. Why? Just because the risk to reward ratio is a little bit extended from the 200. Not bad. It's still valid, but it's a little extended. And what I would like to see next week is if we come back down, have another test of the 200-day moving average, either a bounce with a better risk to reward ratio or an intraday rejection of the 200-day moving average with a better risk to reward ratio. All right, GDX gold miners. Well, it's not there yet. Well, none of them are there yet, right? But look at this beautiful double bottom bullish divergence we have here. we have with the lows here. Look how deep these red bars are. A lot of selling momentum. Then we rallied into green, and now we are lower here than we were over here. But look, the MACD bars are very shallow compared to how deep they are over here. This is indicating a lack of, or a slowing of selling momentum. And if you get a lack of, if selling momentum slows, then the implication is you are going to move up. So beautiful double bottom, bullish divergence, bullish MACD divergence, double bottom ATR divergence, double bottom RSI divergence. I really like big picture what's going on here with GDX, but I still need a signal. And the signals for me at this point would either be if we move down and under 30 over 30, that would be one possibility. The second possibility is that we would rally back into the value zone. Here's the green, anywhere in here, and then have a pullback and then have a higher low V1, V2. And you know, one of my mentors that taught me this, Kerry Lavorne, his absolute favorite, I asked him, what's your absolute favorite setup? And he says, that's easy. It's a double bottom with the bullish divergence, which we have, a rally back into the value zone, pull back, and then a higher low V1, V2. And I would agree with him. These are very, very strong. So I will be looking for two things next week on GDX, either a move down under 30 over 30, or a move into the value zone, a pullback, and then a higher low V1 or V2. Those are the options. And then GLD is gold. You can see maybe you can see the 5 EMA just crossed below the 20 EMA. That's a 520 cross under. Well, just like Apple, if you take a 520 crossover on Apple or gold, either of them do backtest positively, that is a good entry signal. If taken many times, right? It does backtest positively. So next week, if the 5 EMA does cross back over the 20 EMA, I will definitely consider taking that. One other thing I'd like to point out here, potentially Monday, if we gap up, we may have an abandoned baby. And if you don't know what abandoned baby is or an island reversal, go to my YouTube channel. In the lessons playlist, I have a video on abandoned babies and island reversals. So an abandoned baby takes 3 bars. Well, you can see Thursday we closed here. Friday we gapped down. For whatever reason, next week on Monday, if we gap up above Friday's close, we will have an abandoned baby. They're very, very strong signals. Let me see if I have one on here I could show you. Well, here we go over here. See this? This is not a abandoned baby, but this is a island reversal. Same thing. Island reversals, 2 or more bars. Abandoned babies, just 1 bar. But you can see we gapped down. We had 1 day of kind of sideways motion, then we gapped up. This is a bullish island reversal, and that certainly nailed that trade. So we won't know until next week whether or not if on Monday, whether or not we have a gap up, but we very well may have a gap up giving an abandoned baby. But alternatively, the 5 EMA crossing over the 20 would be a consideration. So let's do a quick review on potential trades for next week on the dailies. I like the sideways motion on Apple. If we get a 520 crossover, that's a potential. Boeing, like to have another close back above the 300 with a good risk to reward ratio. That would definitely be a good line in the sand and a good solid entry signal with your stop, with your end day stop being a 300. So a close back above the 300 I would consider. Carnival, another retest the 200-day moving average with a better risk to reward ratio. GDX, if we move down, rejection of the 30 RSI and or move into the value zone, pull back with a higher low V1 or V2, and gold, an abandoned baby if we gap up on Monday, and or the 520 crossover. So those are the dailies that I'm considering. Let's go to the weeklies. I only have 3 of these here on the weeklies. Okay, Boeing had that on the daily as well, but looking for on the weeklies on Boeing a move down and rejection of the 200 week moving average. Of course, Boeing moved all the way down. Now it's consolidating, meaning there's the same amount of buyers and sellers. It hasn't picked a direction yet, but I can tell you, I was teaching this to my student Andy on Thursday. Sideways motion will always lead to movement. Always. We just don't know when, and we don't know what direction, but this sideways motion here for over a month is definitely going to lead to a move, either up or down. And so what I'm waiting for is a move down, test of the 200 week on Boeing. Tesla. All right, so Tesla really got hammered, but it did show some life last week. Now, this is a legitimate signal right here on the weekly. It's an intra-week rejection of the 250-week moving average, and the confluence is a V1. Here's bar 1, bar 2. Bar 2 goes below bar 1's low, close above bar 1's close. I decided to buy Unity software instead on the weekly. Remember, I only buy 1. But next week, I would consider Tesla if we have a bit of a pullback and retest of that 250-week moving average with a little better risk to reward ratio. This one's a little extended, it's fine, but I would prefer if it were to come down, retest that 250 and give me a better entry with a better risk to reward ratio. And then last but not least is VIX. VIX has all sorts of bullish things going on. Doesn't look like it from the look of this chart, does it? But we have all sorts of MACD divergences, ATR divergences, all sorts of things. I've been talking about VIX for a long time, but it just has not triggered my entry signal, and thankfully not, because all it has done is gone down. Right now we're at a 2720 RSI. I'm looking for a close back above the 30 RSI as my entry signal, and if it does close back above the 30 RSI, I will definitely consider it. So real quick on the recap on the weeklies, Boeing moved down, some kind of rejection of the 200. I would consider Boeing. Tesla, a move back down, retest of the 250, giving me a better risk to reward ratio, and VIX as well. I need some upward movement to close above 30. Let's take a look at the S&P 500. So hopefully that was helpful, everyone, and give you some ideas of what I'm looking for. And if it was, please go ahead and hit the thumbs up button. I would really, really appreciate that. But I want to take a look at the markets in general. Of course, we've closed about 5,000 on the S&P. I really honestly do feel like we are getting quite extended here, everyone. We're at a 72 RSI on the daily. We are above the third ATR channel, which is very hard to do to close above it, but we did. But there's a couple things that are concerning me. Look at the trend line to the upside. We take this high, connect it to this high, you go out into the future. Very likely, if we move up and touch this trend line, we'll probably have a reaction and move back down. Not for sure, but let's see, we're at 501. Next week, I could see this going up a couple more points on the S&P 500, but then we will be at this trend line. And being that we're at a 72 RSI anyway, that could be a short-term top. It really could. And then also look at the high we have here. Look at the RSI level here. Now we are much higher than we were over here, and the RSI level is lower than we are over here. So there's some divergences happening there as well. So, I'm not calling for a crash or anything like that, but we are at levels. We are definitely at levels right here that more times than not, that's about it to the upside in the short term. So please, please, please keep that in mind and be very careful with just adding new positions here, because we are really, really at stretch levels. The rubber bands are pretty stretched to the upside. It could continue to go up. I don't know, but please keep that in mind. that at these levels, these RSI levels, these ATR channel levels, it's a little concerning. And I don't know, it was a couple months ago, I was telling you about a wolf wave to a bullish wolf wave, and that is when the S&P was near the bottom. In well, let's take a look at it. Come on, Craig. Down here, this is where I was looking, saying that I was bullish for multiple reasons. But one of those reasons was a bullish wolf wave. Let's see if I can. Here it is right here. Let's do it. Wolf wave consists of three waves. Number 1, 2, 3, point 1, 2, 3, 4, 5. And that 0.5 is usually the bullish entry point. Well, was 0.1, 2, 3, 4, 5. This was the bullish entry point. Was it right? Absolutely it was right. Well, let me tell you now, we now have what is called a wolf wave, but a bearish wolf wave. 0.1, 0.2, 0.3, 0.4, 0.5. We are almost to 0.5 up here. So somewhere in this area, if the wolf wave is right, that will be the top, and we will at least move down to this area. I'm not saying this is going to happen for sure, but I've seen these wolf waves work time and time again, and I just showed you the bullish wolf wave, and that one was really correct. Well, I've 0.1, 0.2, 0.3, 0.4, 0.5, and here we are. And the target to the downside would be about here. So I do expect a move down. The market needs it. It needs some up and down movement. It can't just go up forever. That would make sense technically where we could get down there. So anyway, I'm just saying be careful. That's kind of my call on the SPY, is that we are definitely near short-term highs. So anyway, hopefully today was helpful. If you are interested in private one-on lessons with me, please contact me. My email's in the link in the description. Be happy to talk to you about it. I think taking this course would help any trader. So if you want to improve your trading, you want to learn a skill that will help you for the rest of your life, please email me and we can start. Now, if you are not in the financial situation to do the one-on-one lessons, I have a very affordable alternative. I do teach you the deep dip buy stock trading strategy over on udemy.com. It's very affordable. The course is 9.5 hours, 26 videos, 15 study guides, and I've sold so many of those around the world. I've gotten so many good reviews and feedback on that course. Like I said, it is very affordable, and I teach you step by step how to trade the deep dip buy approach. So the link is there. Again, if you like today's podcast, I really would appreciate it if you could hit the thumbs up button. It really helps out the channel a lot, and it's totally free and easy to do. And then last but not least, please try to go out and do something nice for someone today. Just one nice thing. If we all did one nice thing for another human being, it would really make the world a better place. If you could also go out and do one nice thing for an animal, that would be appreciated as well. Animals need acts of kindness just like humans, and they appreciate them. So one nice thing for a human, one nice thing for an animal. What could it hurt, right? And one day, if you need it, someone does something nice for you, you'll certainly appreciate it. So I really appreciate you being here, spending the time. I hope it was helpful. Hope you have a good weekend. If you're into the Super Bowl, hope you enjoy that. And God willing, if God willing, I will see you next weekend from Colombia, and we'll talk about what's going on in this market. But please be careful, everyone. Please know that we are getting near pretty extreme levels. So keep that in mind. And if you have any questions or comments about the podcast today, just put them in the YouTube channel or YouTube chat section, the comment section, and I'll do my best to get to them. So anyway, greetings from Colombia. Hope you can come down here, visit this beautiful country. And on the way out here, I have to run the use legal disclaimer. Thank you so much, everyone. Talk to you soon. Bye.
disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity.